tackling mine financing trends and where we can get capital beyond the equity markets. So I'd like to invite to the stage Mark Rice, who's at Auramet, John Lamb at Orion Resource Partners, and Lila Murphy at Dundee as well. Thanks for joining me. So yeah, we're going to be tackling where all the lovely companies that we've got here today and at the event can find finance and some of the ways they can structure that, given how what we heard about equity markets throughout yesterday. It's clearly a risk-off environment. That was what some of the macro commentators were suggesting. So it's great to have this wonderful collection of expertise on the panel who can talk us through what's available at the market at the moment, in terms of mining finance, and what forms of mining finance can junior mining companies expect to be able to gain access to in this environment at the moment. So why don't we sort of start with introducing how our roles are a little bit different within the capital allocation sort of journey and process, and then we can get into some of the details of it a little bit more as well. Lila, would you like to start us off and give a short introduction to yourself as well, please?
Sure. Good morning, everyone. Thank you for being here this early morning. I'm Chief Financial Officer of Dundee Corporation, and Dundee is primarily an equity capital provider to the mining industry. We have a portfolio of, I would say 15 key projects that we have continued to finance and develop through the early to mid stages of their life cycle. We do some debt as well, although that's not a core business for us.
Good morning, everybody. Thanks, Adam, for organizing this panel, and thanks everybody for joining. My name is John Lamb. I'm at Orion. We're a asset manager exclusively focused on the metals and mining industry. We invest across the capital structure, typically providing financing for construction financing, late stage development financing, and also mergers and acquisitions. We've been investing under the Orion banner for the last 10 years, and we have about $8 billion under management.
Good morning, Adam. Thank you one-to-one for inviting me to speak here today. My name is Mark Rice. I'm Senior Vice President at Auramet. Auramet is a metals and mining focused merchant bank. I have about 40 years experience just under 40 years experience in finance. 30 of those last 30, close to 30 years has been mining and metals. I spend most of my time these days advising junior mining companies on project financing around the globe.
Excellent. So what's changed in this environment since perhaps we were last here a few years back, sort of speaking, and is it harder now for juniors? Lila, you've said you present the equity piece, so sort of one of a rare selection of investors that are doing straight equity perhaps. But what's changed in terms of that capital raising journey? And then maybe talk about some of the market dynamics, things like the Inflation Reduction Act perhaps. Is that bringing new impetus to invest in these companies? Or is it not yet filtering through to sort of at a significant enough level that companies are seeing a benefit from?
Well, I'll start with your first question. And
yeah,
I came up through the business in the fund management business, and I came up through the salad days where capital was very readily available for mining companies. And, with brief periods of time, the sector has pretty much been in a bear market, and equity capital is fairly scarce, particularly traditional fund management, where, generalists for the most part have pretty much walked away from the space. What has filled the void to some degree is private equity. But the generalist investor is pretty much gone. And so on the equity side, capital is extremely tight and getting tighter.
Yep.
I'd agree with that characterization, particularly for the earlier stage companies. I think as companies become more advanced, there seems to be more capital available perhaps today than a few years ago for development financing, as we're seeing with other groups, particularly more strategic investors or other consumers of metal looking to secure access to raw materials and looking to grow their own production pipeline. So there's more, for development and exploration stage. I think capital is very scarce, very expensive. You really need to have something special to be able to attract broader investor interest. Once you're ready to put steel in the ground and have a compelling project, there's more capital available today than there probably was 5 years ago.
Yeah, and it's due to the strategic nature of metals at the moment and this sort of global supply chains realigning in that respect.
100%, and the energy transition and is highly dependent on metals. Even looking at raw materials, but looking beyond raw materials to the infrastructure that the energy transition is dependent on. All those are metals intensive. So there needs to be more metals production globally to support that. Put on top of that, people focused on onshoring, building back a domestic supply chain, particularly here in the United States. So that's a significant undertaking for that, and will require more metals production. But it's also going to require good projects to be advanced and be ready to go into construction.
Yeah, and how do you see the makeup of the companies out there, available that you would invest in, that Orion would look at, for instance? There's not a lot of these sort of
the biggest challenge is finding very good and an interesting new copper projects. I'd say copper, the copper, a lot of the copper projects that are out there today are ones that were advanced but weren't high grade enough to be producing in the last development cycles. So seeing new high grade copper projects in established markets is more challenging, and everybody's looking for copper. So there's a lot of competition. If you've got a copper project, you'll probably be very able to get financing if you have a robust project. I think for us, the other metals that are very interesting are the metals connected to the energy transition. We see them having a very strong macro outlook over the medium term. But at the end of the day, we're looking to invest in high quality projects, and less focused on making sure we have a project in a specific metal. We want to see our projects that are resilient across the cycle. So that means investing in better projects, and that's going to be ones that have been advanced and de-risked progressively over time.
Yeah, so less on the sort of big thematic necessarily on the commodity, but more about that project specific, and then
correct. Yeah, I think the commodity thematic is important. You want to have that outperformance. But at the end of the day, we're not going to invest in a marginal project because it's in a commodity that we like.
Makes sense. Mark, you see a lot of deals with what you do. Can you talk about some of the trends that you're seeing at the minute, or some of these difficulties in sort of assembling capital for juniors?
Sure. I don't think anything's radically changed since the last couple of years. I think the trend continues. I'm not in the equity side like Lila is, but I agree with both of them that it appears that the generalist is maybe not walking away, but maybe putting its money with royalties and streaming companies, which have grown exponentially in the last 10 years. That's a trend that looks to me to continue. Private equity funds have grown exponentially in the last 10 years. They're also attracting capital. I suspect it's coming from many of these investors who struggle to evaluate the risks that where they're putting their money, and feel that royalty streaming companies, private equity companies are better allocators of their capital than they can be as a generalist. I've been in the industry 30 years, and I still struggle a lot of times trying to figure out the good, the bad, and the ugly. And so if you're a generalist, I think it's much higher risk. So the trend, I think, in capital, like we've both said, is there is capital there. I think it's just moved to different places.
Yep.
I want to echo something you said on the royalty side. So Dundee is in the process of putting together a financing package for a joint venture for a project in Brazil. And I think given the premiums that the royalty companies, the publicly traded ones, trade at, their cost of capital is so low, it's actually pretty competitive with bank debt in a lot of cases. It's pretty remarkable. So to your point, once a project has gotten to a place where you've got the ability to move forward with a development decision, the capital is very much there. But between that early stage and there's a real dearth of equity capital.
Yeah, it takes 10 years to get from point A to B on that, and significant capital. I think as well, one trend that we're seeing is allocation to capital towards larger projects that show larger potential. It's just to see if a gold project has 100,000 ounce a year production potential, it's not going to get the same amount of capital attention that it might have received 10 years ago, because there's you don't have the big prize that people are looking for at the end of the day. So it's not gonna have as much exploration dollars put into it. It's not gonna have the level of study. So it's gonna be a higher risk project. So we're seeing, I think, less capital available for projects of that nature, and more capital going towards things that show really large scale potential, because at the end of the day, those are the projects that are going to be more meaningful on a global stage.
Yep. Yeah, there's just de-risking it in that respect. And what about sort of joint investment, or sort of going in with other investors, other finance providers, to de-risk a project? Is that quite common now? Is that something that's happening a lot more?
Yeah, I think as an investor, I like to see other good people around the table that have capital available to invest in a project. The biggest fear of any investor is that they're the last one that's able to write a check, because in this business things are always going to take longer and cost more as a general rule. So you need to have others that have the wherewithal to support your project throughout the cycle, and something that's just able to attract capital at the peak of the cycle is going to be a very challenging value proposition for an investor. But one that shows potential and has other groups in there. We're very happy to invest alongside other groups, and you've seen that on a number of our recent transactions. And that speaks to the quality of some of the projects that are out there. There are very good, exciting projects, and at the end of the day, as an investor, I want to have exposure to a large number of projects. One way of having my capital go further is to invest a portion in several projects versus putting all my eggs in one basket.
Yep.
Yeah, and I would say at this point I spend a lot of my time getting to know people like the two of you, because it's really important for us as equity investors to have visibility on who else is providing capital along the stack, and whether or not the project actually still makes sense given the total financing package. So I think relationships are really important, whether it's in your chair or mine.
Yeah, I completely agree. This is the nice part about this business, particularly on the for people that are sector focused. There's people tend to stay in the sector. You have a good sense of who the stronger counterparties are over time, and you can gravitate to look for what they're doing next as a management team, and look at what the other investors in the space are where are they spending their dollars.
Yeah.
And I would say that the challenge of the equity market right now makes partnerships in financing trying to minimize the equity contribution. So you see a lot of times royalties and streaming deals with banks or with private equity as a combination, and sometimes you even add in lease financing from Caterpillar, Komatsu, so a combination of different parts of financing. I think there is an element of safety in numbers. Other people have validated it too, so it kind of keeps everyone happy. And I think anyone who's done business in the sector knows that it doesn't happen according to the spreadsheet. You know, there are going to be bumps in the road. The banana skin does always appear. You don't really, you know, I've been involved in many projects. You think that's the risk, and that one turns out to be fine, and it's something completely out of left field. But it's good to, I think John's right, not to be the only guy with the checkbook. You want to have a couple of people with checkbooks that can help solve those banana skin moments.
Well, and as the equity investor, we're particularly sensitive to that banana skin moment because we're way down at the end of the capital stack. But I think, you know, you've seen a lot of examples where the financing package is put together such that it can kill a project. So the stress testing assumptions that we use are fairly robust to make sure we have a margin of safety that doesn't kill us.
I don't know many lenders that are looking to kill projects. I don't know many lenders
all the time.
No, and I don't know many lenders that are looking to own mines, right? I mean, there have been over the last 30 years a couple of groups that might have been a bit loan to own, but I think it's the last thing that most lenders want to do is get into a foreclosure situation. Everyone loses money, credibility, reputations in those things. So, you know, badly structured deals or over leverage it's a two-way street. The company wants it, you know, and someone's going to give it. As I said, I don't know any deal that's ever worked according to the spreadsheet. You got to realize that there is going to be those banana skins, and like John says, you've got to know where additional money can come from, and you don't want to be the only one that everyone's turning around looking at.
Yeah, very, very true. What's inflation and the sort of OpEx doing to deal flow at the moment, or changing in terms of, is it slowing things down? Is it changing the way that you're sort of approaching some of these co-financings?
I would say last year it was out of control. No one could really put a pin in it. We saw a number of big projects in Canada get devastated. The amount of equity investors that had to put money up for, I don't really want to name names, but I don't think anyone could put a name in it. I would say anecdotally, I'm optimistic right now because I talk to clients and mining companies. It seems like supply chain issues are improving. Inflation is hopefully under control with a view to perhaps maybe it starts to, come down a little. And I also hear, which I think was one of the biggest challenges last year, was labor availability. And labor is now becoming more available to people. And that's a large component of the cost for any company. So I think a combination of all of those things makes me a little bit more optimistic as people looking to develop projects and build projects going forward. But the last couple of years have been crazy, man.
Yeah, I'd say. The inflation is certainly eased on the capital side. I don't know if that is as much a function of the overall inflation easing versus just some of the factors that Mark talked about being alleviated and the pressure coming off. I think at the end of the day, capital projects can overrun significantly even in a low inflation environment. It really comes down to how you're truly advanced and how well understood and how ready to execute the team is on the project. I can remember an instance of a project overrunning by 40%, back in 2018, 2019, when inflation was zero. So it's really not necessarily dependent. It comes down to, it seems like the biggest issue is always geotech. If you're going to have a massive capital overrun, because that's one that just can escalate and snowball quickly. And it's at the beginning, so the overall construction timeline is going to be extended. I think the other aspect of project development where we've seen a lot of capital overruns is on the infrastructure side, because mining companies are not good at building infrastructure projects. I assume infrastructure companies wouldn't be good at building mining projects. But the reality is, in the mining business, you don't always have the blessing of being able to choose where you're going to build the mine. The mine tells you where she's going to be built. So you have to bring all the infrastructure to that, and we've seen an increase in the number of projects that are in more remote areas, which means you're going to have that larger infrastructure component, which just has a different different payback and a different investment profile than a mining project.
Yeah, I don't have a ton to add beyond what these two gentlemen said. I think it is a bit of a Goldilocks scenario, particularly in gold, where gold prices have stayed pretty elevated, where then you've also had this moderation of inflation. So, I think if you're putting forward a feasibility study today, you've got a reasonable amount of assurance that you're going to come in around on budget. Now, I think a bigger risk is, what is happening politically in the world and all of the mining jurisdictions and resource nationalism and changes to the structural agreements between companies and governments. I think, if there's an inflationary risk there, it's around that element.
Yep. Chile was mentioned a lot yesterday, and with what's going on there, but you see this trend amplifying by the nature of kind of the way that the world's dividing at the minute geopolitically. Yep.
Yeah, I think countries are very very focused on making sure they're self-sufficient, and at the end of the day, governments are some of the biggest borrowers on the planet, so they're looking to maximize their own revenue. In a time when commodity prices are very high, it's an easy target, and something where companies need to be conscious of the environment that they're operating in, develop the right relationships with the stakeholders on the ground to be able to successfully execute on a project, because I think we're moving into a world that is going to have those issues with increasing frequency and increasing concerns around what does that look like. Uncertainty is it makes it much more difficult to raise capital.
Yeah, but is that changing where you're looking at structuring your portfolios and the companies you look at? Now North America, by virtue of sort of being perceived safer jurisdiction, are you pivoting more there? Are you reducing the number of jurisdictions that you would look at projects in because of this trend?
I'd say we continue to look globally for projects. We would like to have a balance between the more established markets and then more emerging markets within the portfolio, because typically you're taking different risks. In the more established markets, you might be taking more operational and executional risk around the project, or permitting. Typically we try to avoid permitting risk. We've had that's one area where you just can't you can't predict it. It would always take longer. I've never heard of a project that says it was going to be permitted in 2 years and was permitted in 18 months. Seen plenty of projects that have been 2 years away from permitting for the last 10 years. So that's really unfortunate. But hopefully that trend will change, because that's a gating item to seeing more metal come onto the market.
I think the litmus test is, does this country want our capital? I think that's the first thing we look at before we even evaluate a project. Does this jurisdiction actually want foreign investment capital in the mining industry?
What about here in the US? What about with the Inflation Reduction Act? I know you keep referring to it, but is it changing the sort of appetite for mining or permitting in projects here? Given the US is a net importer of metals, but it wants to build its green plan and its own infrastructure. Story.
I'm trying to make heads or tails of it. The US seems to be very focused on building out processing capacity for anything in the battery metal space. But if you wanted to permit a new copper mine of any scale, it seems like there's still all the same roadblocks in front of you. So I'm not sure where the raw materials for these processing plants that the government seems to be giving plenty of tax incentives towards, and actually putting capital into. We'll see how that does materialize, because you need the raw materials to be able to or have access to the raw materials to process it. So that's the biggest question in my mind is the U.S. wants to be in the the industrial park version of the business and not the upstream. Yeah.
Yeah. Well, will it lean on Canada for that, and then friendly neighbours will get it done?
I think very much the U.S. can be divided into Nevada and every place else. I think in Nevada, there are essentially no hurdles to getting a project moving forward. But the rest of the United States, it's tough. There's a huge not in my backyard NIMBY contingent who like the idea of mining. They like the benefits that critical minerals and EV bring about. But then when you actually go to try and move a project forward, there is no certainty around timelines around getting that project moving forward.
Mm. Yep.
I think that extends beyond just mining projects, but
yeah, fair.
My town has been trying to build a cell phone tower for the last decade, so.
I have a couple of observations. My colleague was in DC a couple of weeks ago talking to EXIM, Development Finance Corporation. The current administration is going to change may not change in a year's time. So the current administration is very focused on anything that's in pro environment. So if they can encourage the development financing, government-owned, state-owned organizations to follow that agenda, that's what they're saying right now. Now, if we have a different administration in a year's time, then it may be these development banks will change the tune based on who the new boss is. So I think that's we live in a democracy, whether it's in Latin America or North America. Things move right and left, and mining projects are long-term assets. So you have to kind of take a long-term view on democracy and on which countries want your capital or don't want your capital. I think the other trend that you see happening now is in the electrification story is we're seeing the auto OEMs starting to come in and put their balance sheet to work with debt and equity dollars into lithium projects, cobalt, nickel. So I think at the BMO conference in March, they renamed it, and I think there was 10 of the top 11 car manufacturers there. We do a lot of business in our physical trading side on PGMs, and we know that the auto OEMs are very hungry to establish relationships for long-term offtake for nickel, cobalt, and lithium. So there is money coming from those guys too, and they're all scrambling.
Yeah, Mark, I would agree with that. I think if you're a mining company counting on government subsidies, you're probably you have much more security around capital availability if you partner with a GM or a Ford versus a government, which may or may not have the same motivations in 2 or 4 years. So I think those are going to be the most likely partnerships we see. It's not going to be with governments necessarily.
The challenge is the car companies know nothing about mining.
Absolutely true.
Yeah.
That's not going to stop them.
And the other interesting thing I notice is that the independent engineering firms, that finance groups like John and banks that I used to work at, they're scrambling to hire chemical engineers. It's not hard, it's not hard. It's all chemistry now. So the growth is in the engineering, is in ESG, environmental, social, and corporate governance. That is very big, and it seems to be a growth in chemical engineering and processing of lithium, all the different types of that. So,
yeah, that's a underappreciated. Well, maybe not in this group, but I think underappreciated thing from the last few years as we've seen. More capital going into energy transition. That's a very different approach than investing in conventional copper or gold projects, where the processing side is very well understood. The amount of value creation that takes place in that in that processing stage is significant, particularly with the energy transition. And it's really not a mining operation; it's really a chemical operation for some of these, and that's a different risk profile, different fact pattern that it takes. It takes a better understanding on that piece to be able to make good investment decisions.
Yeah. So there's a big educational and skills sort of piece required for these industrials and the OEMs that you mentioned that are scrambling. They're going to have to really ramp things up if they're going to meet their EV quotas and that kind of thing. Interesting.
Yeah, I mean, I don't know that any EV target is realistically feasible, from the mining side, but also from the power generation side. If an EV consumes as much electricity as a house, that's essentially the same as putting a house, an additional house on the grid. We should be building more nuclear power plants, et cetera. It seems like there's plenty of new wind and solar development going online, but that's intermittent and require battery storage. And it's seems to be more replacing coal and other fossil fuel sources of energy versus adding new electrons to the grid. So I don't know that that's achievable. It takes probably as long to build a power plant as it does to build a mine. So if we're talking about having 25 going from 25% of vehicle sales to 50% of vehicle sales being electric, to me we should be building a lot more power plants.
John, the infrastructure point is a very good one. I scratch my head at copper having been left off the critical minerals list. Like, where is the power going to come from to power all these electric vehicles? Like, without copper, it's not going to happen. I'm left scratching my head.
Yep. Fair point. Yeah. Does anyone have any questions for our panelists at the moment at all? Yep, gentleman here.
Yeah, I think the word upstream has come up in pretty much every one of these presentations. I think that's been a huge focus from both the production and sort of, as you said, in the EV space, and control and verticalization perspective. But then also, as you echoed earlier, the capital availability in early stage and upstream is essentially non-existent. It's as tight as it's sort of ever been. Those two things seem difficult, if not impossible, to sort of rectify with one another. There's all this sort of desire for royalties and refinery, but almost no desire for capital going upstream. What do you think really turns the tide or sort of changes the institutional ethos on that and makes capital more available in the early, sort of in upstream and early side production? Because it seems to be we're approaching somewhat of an untenable state the next few years.
That's normally when it changes.
Yeah.
Is it?
It's gonna force tightness in supply. That's gonna push prices higher. That's gonna bring more awareness to it, and then there's gonna be a scramble for putting dollars to work, and then it's gonna further exacerbate the cycle. But there's gonna be a period of higher prices. More projects will get through that point. But it is a conundrum that has only gotten worse over the last 10 years. I would have thought it should have been broken a couple of times by now, but it just hasn't happened.
I mean, from the equity perspective, I think we see a ton of projects come in and out of our doors, and historically, not all of these companies have been the best stewards of capital. I came up through the industry in 2004, and that was very much the salad days. But what it ushered in was a lot of capital misallocation. So, in a way, it's good that the industry has been somewhat starved of capital because it makes sure that, the cream rises to the top. But, like for us, we do a tremendous amount of technical due diligence before we make an investment. And, it's a very, very, very gated process, and only a handful of companies make it through.
That's perhaps. Oh, yep. Front. So, gentleman here, and then we'll come over here. Yep.
Is there a sweet spot, or set of criteria that you look for in, my financing project? In terms of
I think it's got to be a project that's has some resiliency on to be able to withstand capex overruns, tighter margins, whether that's because of higher operating costs or lower commodity prices, and then something ultimately that is scalable over time. So something that has enough resource behind it that you could see a much longer life, or be able to grow to a larger production profile. You got to have the right combination of those elements. To have something where you're lacking one of those, it's going to be very difficult to attract financing in this market.
And for us, management also plays a critical role. Now, I'll give you a bit of an anecdotal example. We were standing around yesterday's cocktail hour having a conversation with a company, and the debate was whether or not to move the project forward or to keep the lights on. And I sort of stepped back and thought to myself, well, if you are not moving the project forward, what is your reason for existence? And there's a lot of that out there. There's a lot of, what I'll call lifestyle companies. And, it's a bit of a frustrating filtering process as we have to look through a lot of that stuff.
Has it changed sort of like versus 10 years ago maybe, or sort of at the bottom of the cycle or the last cycle, in terms of like not just management teams, but how the companies have performed in that respect?
I would like to say yes, but I heard the CEO of a mining company that shall remain nameless, who said there's a new crop of suckers born every 7 years. So, they're just looking for the next generation of those who maybe have equity capital to invest, but don't know the space very well.
Yeah, I'd say a great management team can make a pretty average project, something special and get good value. You can have the best asset in the world, and a bad management team will find a way to break it.
Yep. Fair. Yep. Well, look, we're pretty much run out of time, and we've got some management teams to hear from. Perhaps you could grab the panelists on their way out. But look, thank you very much for setting the scene this morning and taking us through those trends. So thank you to Lila, John, and Mark.